Thank you, Isha. And good afternoon to all our attendees and a very warm welcome to a very esteemed panel. As all of us are coming out of pandemic, the economy is looking strong. And when we started the year, we were all talking about a double-digit growth rate. Although some of those projections may have gone a little bit haywire because of the international conflict. But all of us should understand that in a country like India, where financial inclusion is still at a very small and nascent percentage, the role of NBFCs in building the country is second to none. And today in the panel, we have got five very eminent people who, in their own way, are contributing to building of the nation. What we will spend next 59 minutes with them is understanding how they are going about doing their business, what are the challenges they are seeing, and how do they see next few months and next few years in terms of building this business and also contributing to the economy. Thank you very much. So I will start with Rakesh ji, if that's okay with everybody. Rakesh, good morning. Good afternoon.
Good afternoon.
Yeah. So you come from one of the very large NBFCs, and there was a lot of excitement a couple of years ago. I can recall that there was a talk by RBI that they will allow NBFCs with 50,000 crores plus of assets to be converted into the bank. And after 2 years, we haven't seen much of that. What we would like to understand is, do you think that would progress any further? And, if it happens, what do you see as an advantage as a bank, and how it can help you support the growth of the NBFCs and the economy if that was permitted?
So thanks, Dinesh. Good afternoon, everyone. We are also waiting for the guidelines and the final guidelines. Yes, the working group of RBI had recommended banking license to be given to the corporate houses. But we will wait and see what the final guidelines are and how does it really work for an NBFC. And basis that only any decision can be taken. But yes, I think it really helps the NBFCs if your liability is taken care of, and if you are a bank, then you can access the retail liabilities through your customers, your own customers, whom you are lending or you're giving money, but their liabilities are being managed by other bankers and all. So I think what it does is, from an NBFC point of view, it builds a sustainable and a long-term liabilities. Because what happens for an NBFC is that every 3-4 years there is some crisis which will come and disrupts the liability side of NBFC. So if we have to really build a large-scale business, I think the liabilities, which is the core to our business from a lending point of view. So it's important, critical that we build and we have access to the retail liabilities. Today, we are dependent on institutions to borrow, and that changes given if there is any crisis. And what we saw in 2018 post IL&FS crisis, there was a liquidity crisis for the NBFCs, and which impacts your business plan, your growth plans, and what one can do. So banking provides us a liability, a more sustained liability for a period of time, so that you can plan your assets and your lending as well. So important and critical from an NBFC point of view. But to answer your question directly, we are also waiting for the guidelines, a clear guideline in terms of what it comes out. Yes, RBI came out with a different classification of NBFCs, and post October 22, whether you are in the middle layer and upper layer categorization, then your capital requirements are different. So if that also happens, I think it should benefit for a large NBFCs. It should better. Uh, it should be beneficial because I think we will have a tier one capital advantage. What they have recommended for per layer is 9% from a 12% current 12%. So we'll wait and see, Dinesh, how it goes and what are the further clarifications and guidelines which comes from, and then assess our position to take any decision forward.
Okay, Rakesh, that was interesting. So just to summarize for our audience, I think the message was that, access to cheaper capital and long-term capital through retail sources would definitely help in proliferation of credit also through NBFCs. And any, stronger NBFCs obviously can be given some more leeway or some flex than what is available. That's what Rakesh was referring to, and we will all wait to hear what happens more. Something which is in works right now. So let me come, and anybody wants to add anything to this, that would be very interesting, because all of us are waiting with, a lot of patience on what happens on this ground.
Dinesh, can I add something to this?
Absolutely.
Kshama here. Yeah. So no, I completely agree with what Rakesh said, and I do want to sort of give a different light to this. A lot of the NBFCs, and particularly a lot of the NBFCs that Northern Arc has been working with, and we'll be working with hundreds, of course, are really NBFCs that have reached out and touched their borrowers for the first time. They have made finance accessible. In some sense, they have made the client aware of the whole, ability to access a formal financial ecosystem. And then to not have one part of that ecosystem available becomes a bit unfair, because you would want to keep your client, you would want to keep your customer, you would want to provide a holistic solution as far as finance is concerned to the customer, and not just lose the customer because there is one side of it that you can't really do, which is basically the deposit / liability side. So I do think that NBFCs have played a very, very big role in bringing that customer on board, and we need to find ways for the NBFCs to provide whatever services that customer needs, liability, asset, and so on and so forth.
Okay.
So maybe I can, if you permit me, I can add to what Rakesh and Kshama kind of mentioned. I mean, I think the first question is, why do you need to be a bank? And as Rakesh said, it gives you stability, liability side. And as Rakesh said, every 2, 3, 4 years, there is some crisis which paints NBFCs with a bad brush. Now, what is stability on the liability side? I think if you really look at it, I look at it into two parts. One, you get access to the RBI liquidity window. And second, you have access to retail deposits. Now, retail deposits by nature are on-time deposits, which means someone can withdraw any time that they want. But still, it is perceived to be stabler than when NBFCs borrow from the wholesale market. So while it is great, the higher the CASA, the banks benefit. But for an NBFC, this asset liability mismatch has made out to be a big, big issue. So I think if liquidity measures are made available to NBFCs, similar to what the banks enjoy today, I'm not sure every NBFC would want to become a bank or would require to become a bank, to what Kshama said, to further the financial inclusion objectives.
Thank you, Gaurav and Kshama. And that was, good take on this. I didn't expect actually so many responses on this one, but this looks like a very emotive this thing. And what I can figure out is all NBFCs are feeling that they are running a race with their hands tied at the back. So hopefully there would be some flex which would be made available, which will allow them to run faster and access capital in a cheaper and a faster fashion from the retail markets. And I'm sure, somebody is watching who will take note of the responses which have come from 3 of our panelists. Next, okay, let me come to you, Gaurav. Then you come from a group which never has any problem of liquidity. But if you talk about the sector as a whole, there have been we talked a brief bit about, Rakesh alluded to it, both of you, Kshama and you alluded to it, that once in a while there are liability mismatches, and we do end up, especially the smaller NBFCs, feeling the heat of it in tough times in terms of the liquidity. So, the key thing is that, why, in terms of the what are the key reasons that why do these smaller NBFCs in these tough times have a tougher challenge to manage the risk? Is it due to poor governance or risk management or lack of good manpower? So, you would have seen a lot of these happening around you, in the industry, and how that can be avoided.
No, so Dinesh, I think like banks and NBFCs, we are in the lending business.
Yeah.
So if we have to look at, we as an NBFC wanting to lend to a borrower, we will also look at, where we think our monies are safest to lend.
Yeah.
And from that perspective, we will also base our decision on the basis of where we think money is safe.
Yeah.
Now, when we start describing that in the context of, NBFCs, what is safe? Someone who's more established, someone who has more equity, someone who has a bigger parentage, clearly they are deemed to be safe. So by that logic, a newer NBFC, as you mentioned about, like in any industry, a newer player, whether it's a paint industry, whether it's a tire industry, will always find it relatively more difficult to raise our commodity or raw material, which is finance, than a more established NBFC. But I think in the last 3-4 years, I think be it post ILFS, post DHFL, be it a newer NBFC, or for that matter, even a larger NBFC, NBFCs generally have had it harder, and I'm saying harder from a relative perspective, to raise liabilities.
Yeah. Yeah, no, fair point. I think that has been the bane, and that's attracting a lot of emotions on this, panel discussion also. So, anybody would like to add anything to that? In terms of, obviously some structural shift in terms of, which have been already been suggested, but anything else that we need to do to alleviate this problem for the sector? Okay, so let's
Can I just add one point here?
Absolutely, Kshama, go ahead.
So I do want to make a distinction here between the nature of small NBFCs one sees today versus, let's say, nature of small NBFCs once of 5 years, 10 years ago. I think the entire sector per se has become very, very sophisticated. The kind of people, the kind of management, the kind of investors, the kind of governance and reporting systems that exist today are not the same. And I think one should keep that in mind when one talks about the challenges that NBFCs face. So truly, these small and mid-size NBFCs deserve the capital, but don't get it because it's associated with the size. But the size is not exactly what it was a while ago. So I think it's important to recognize that the profile of NBFC promoters, investors, the way the business is done, technology, everything has changed in the last 5 years, and we absolutely need to sort of take that on board.
Okay.
It's a different industry.
Yeah. It keeps on changing at a very fast pace. So, Umesh, let me come with the next question to you, and this is probably the topic, and it would probably be less emotive than the first two questions that we have put in, but it is more important, or at least as important as the others. That India has an aspiration of becoming a 5 trillion economy. What do you think is the role of NBFCs going ahead, given all the conflicts around technology, around commercial banking, etc., that one can play? And you run the largest book in the country. So we start with your views on this.
Yeah, thank you. As the previous speakers have expressed, the challenges of NBFC in this industry, small, beginner, and maybe. So what happens is NBFCs go through various different phases, and as the economy and the regulator, they keep changing their what you call views and regulations, or sometimes restrictions. So NBFC also have to change the way they do businesses. So what we have seen in the last 20, 25 years, things have changed. Earlier, most of the NBFCs used to be standalone, specialized NBFCs. They used to cater to one particular need of the society, and maybe in restricted to one particular geography. But over the period, NBFC have started doing a multiple activity, multi-product, multi-geographies, and therefore we also have grown over the last 40, 45 years. We have grown over the period into various geographies, and now with the merger, we are trying to get into various section or segment of the society, or the where it is a credit star. See, we are where we are. NBFC has to focus is where there is a under penetration of banking, or there is no credit from the banking. So that is the area where NBFC can do service and flourish. So we are either complementing or supplementing banking. And as you rightly told in the beginning, that India is highly credit starved and under-serviced as far as the banking facility or service is concerned. It is not only in lending, even in the savings, I feel it is same. So I feel that we need to be there in every part of the society as we become large, as we build enough experience and expertise. So by bringing the two companies together, we feel that the current generation of the Indians, where many of the families or societies, they're doing multiple businesses. They're not, that's earlier you could see that they will do one particular job, not multiple jobs. Today, I have seen large number of families, they do multiple jobs. So especially in the tier 2 or 3 or in the rural area, joint families will have multiple business, like one person will be farmer, another person will be driver, another person will have shop, or another person will be retailer. So within a joint family is having multiple businesses, but it was not the case 20, 25 years back. They used to have one single source of income and they used to depend on that. And as the market or economy or the profile of the customer is changing, we also need to change. So that's how we are trying to build that into our business model, and also trying to serve them on other things like insurance, savings product. So that also we feel that it is necessary for us to service the these customers which we are targeting. And in the pyramid, if you look at a pyramid, the top end of the pyramid is always serviced by the corporates, or the salaried class are always serviced by the bank. And it is the bottom of the pyramid or mid segment of the pyramid that is unattended. And most of the NBFCs are in the mid portion of the pyramid, which is pretty large. Even though bottom of the pyramid is also a large, but it is a narrow bandwidth. But mid segment is large enough where you move from lower middle income group to a higher middle income group, depending upon the size of the loan or credit required. So that flexibility we are trying to build in our business model, so that we reach out to SMEs and individual operators, all business communities who are typically under banked by the. So that's the whole plan, and I feel NBFC will fill the major gap. All NBFC industry will fill the major gap for the growth, because that entire, if you look at the job creation is done at this particular segment, mid segment. corporates are not creating jobs. They are maintaining the existing jobs, but I don't think they are creating a fresh jobs. Maybe startups are creating a fresh jobs, but definitely not the large corporates. So it is the mid-income or mid-businesses, mid-sized businesses or small businesses that are really building the economy, or rather the creating opportunity to grow. And that segment has to grow much faster so that India reaches 5 trillion economy.
Absolutely. I think this was very insightful and comprehensive reply. And I'm sure everybody would have liked it. But in any case, anybody wants to add or elaborate any of the points which Umesh
Umesh,
made?
with your permission, I'll come in just to
Sure,
add.
sure.
Completely agree with Umesh ji. So let's look at the macro. 3 trillion of dollar 3 trillion economy. Yeah.
Yeah.
If we aspire as a country and economy to reach 5 trillion, then we'll need a growth rate of roughly 12 to 15%. And that cannot happen without credit growth rate being where it is or better. Anyways, compared to most developed nations, we are far lower. We would be, last report I think was 2020, less than 100%, vis-a-vis, let's say US, China, all 150 to 200%. If we have to be a 5 trillion economy, and it's an, I personally believe it's doable, but it's aggressive from a timeline point of view. It's already been once revised from 24 to 25, FY 24 to 25. We'll need at least a estimated growth rate against the 14% mathematically to, let's say, a 22 to a 25%. Last mile credit, the role that Umesh ji was talking about, can only be played by non-banking finance companies. 1 lakh entities in India, all put together 30, 35, less than 35 PSU private, PSBs and private banks who are very, very active and large. 2000 NBFCs, I would say, all put together would be very large, but their penetration is far deeper. Let's take some examples. Let's look at consumer durable. Not naming one or two companies, but clearly NBFC market share against 15 to 20% on the overall market. So if we look at assets, NBFCs would be 40 lakh crores, whereas total market would be 160 lakh crore. Roughly say 20% would be NBFC. But let's look at consumer durable as an asset class. Nearly about 50% is led by NBFCs, leading NBFCs, 2, 3 of them. Look at agri and tractor, closer to the economy. Significant percent of India's workforce comes from agri, and the contribution it does. Tractor financing, if I'm not wrong, would be upwards of 50%. Housing, or let's look at affordable housing. Affordable housing would be again upwards of 40%. I wish I could say the same for education, which is closer to my heart. But in education, 1 lakh crore assets under management, and while we are the 8th largest bank, non-bank, in the education asset category, I think NBFCs put together are only 12%. Clearly, the last mile delivery can happen through NBFCs, is what I would want to add. And primarily because of the sector niche specialization, the distribution and servicing capabilities that NBFCs bring, which are complementary to banks. Last but not the least, a very hybrid model of conventional underwriting, ability to understand the cash flows on the ground, and overlay using agile adoption on risk analytics and alternate data today. I think this will help bridge the gap on unbankable, as Umesh ji said, or for customers who banks may not really want to lend to. Back to you.
No, thank you. I think this was very good. I think, it makes me believe that if we are able to get this target over the next 4 years, I have no doubt that all of us on this call will end up becoming richer. What I am not able to decide is that over the next 4 years, will we have to work harder or less if these growth rates are being achieved?
Well, Dinesh, as Mr. Murthy says, technology can do a lot of things, but cannot replace sincerity, hard work. I think we know the answer, right?
Yeah. So that is what I was basically coming to. I mean that everything is now about that leads me to my next question, that all entities are transforming themselves, all companies are transforming themselves, all sectors are transforming themselves, and NBFCs are no exception to that. And now we are basically in the world where digital lending is the key thing, and digital lending companies get a valuation which is far better than any other normal traditional model. And so that brings me to the question: is it that uh, to get to those targets, would it mean working harder? And obviously working smarter is something which we can all live with. So what do you think the world is going to evolve as far as digital lending is concerned? And we have seen all kinds of companies coming into this space. Will they be able to achieve the size which we are seeing right now in normal traditional NBFCs?
So I'll give you my view, very, very simple. I also believe that most of us on this call today, people on the panel, and all the people who are attending, most of them would have either read in detail or definitely seen the headline around the working paper on digital lending. And this is
Yes.
sector agnostic, doesn't matter whether you are lending for education or you're lending for which asset class, the principles are the same. I personally believe, well, there will be, I'm sure there will be a lot of views around this one, but my own personal opinion is this is a very, very progressive action. What is the guideline from the regulator around it? If you look at the spirit, it's only just two simple points, or maybe at best three simple points, right? First and foremost, what our regulator is always said: protect customer interest. What do you mean by that? Be transparent, ensure the consumer understands that what he or she is availing is what are the terms of the loan. Follow the fair KYC and FPC guidelines. Last but not the least, no usurious pricing. There are people who, in the garb of fintech, offering 30% IRR loans. Now, I'm not commenting on their business models, but clearly the regulator has a view, and rightfully so. Um, the second big point, which is at the core of this working paper, was what? Transfer of systematic risk from unregulated entities to regulated entities. Or in the currently unregulated entities, can this be regulated? Because an entity which is not regulated is giving loss default guarantees, then will it translate to people giving such guarantees which are far beyond their reach? So a fair regulation framework on top of it should be existing. And last but not the least, there should ideally be, if you honestly ask me, I would say there should be a proposal for self-regulation for all fintechs, edtechs, um, insurtechs, essentially anybody who's bringing and leveraging technology for last mile delivery and taking, naturally they're delivering experience to the user which the user wants, right? I'll give you our very own example. We can do a 50,000 rupee education loan if you're thin file or thick file on the bureau, in a very, very seamless manner through API integration with an edtech manufacturer in less than 10 minutes, in seamless manner. And we are integrated with all bureaus in the country. But we have to ensure, right, that we protect the customer interest. So just for the benefit of the audience, I represent Avanse Financial Services. We are a customer-centric, digitally agile non-banking finance company focused on governance, risk, compliance, liability, and then gaining market share is how we think and work upon. Our shareholding is Warburg Pincus and IFC, so as sovereign as it can be. We believe niche NBFCs deliver larger customer proposition. As part of this journey, 36 months ago, we had launched our EdTech financing business. Happy to share with you, we today work with close to 200 EdTech manufacturers, marketplaces, and partners. And we managed to meet the aspirations of 2 lakh plus children, especially in COVID. If we would have not played the last mile delivery role along with these manufacturers, we can all imagine what could have been the impact on people not being able to pursue their academic aspirations. Uh, Back to you, Dinesh.
Yeah, thank you, thank you. That was a very passionate, you know, topic for you. I can see that. But for any of the other panelists, because I'm sure you are seeing digital disruptions around in your particular, from startups. So anybody wants to share their views on how this whole digital thing is going to shape up,
Yeah, so Dinesh,
would be very welcome.
if I can just add, if you look at in a country which is as diverse as India is, and the income levels are very low, the ticket sizes are very low, and why the banks, whether the PSU banks and the private banks, why did they struggle? Because the cost of delivery was more than what you can really make money from these small ticket, because the income levels are low, so the loan requirement is also low, and cost of delivery was so high. So financial inclusion, which was visualized, and we had an aspiration, and that was the reason why banks were nationalized, but we didn't meet that objective. I think technology is one way in terms of delivering small micro loans, sachet loans to low income customers. And I think that's the key to really meet the financial inclusion and reach out to the last mile customers across this country, whether we call it a microfinance or digital loans. So I think technology has to play a very, very strong role. And if you look at from our infrastructure point of view, what have we done over the last 5, 6 years? I think we had a KYC. Aadhaar is one of the best in class in terms of the KYC. You can authenticate the KYC of the customers. Jan Dhan was done and the mobile was integrated. So a lot demonetization happened. A lot of customers moved their cash into the banking ambit. So now you can integrate, you can verify the customer, you can verify the income through the banking channels or the bank statements and all. And if you can assess a customer and can deliver a small micro loan or sachet loans to these customers, because the larger part of India requires a small ticket loans, and how we can deliver that small customer loans at a fraction of a cost. And that's the digital capability which we need. So that's a need of India as well in terms of meeting the financial inclusion and reaching to tier 5, 6 markets and to the rural part of India. So it's key, and I think it's very, very important to really use technology to reach the last mile.
Absolutely great, Rakesh. So basically, technology is going to touch every sector and every company, whether small or big, and we need to adapt it. And one thing that, as a country, we should be very, very proud of is the way we have adopted digital infrastructure, especially in payment space. And, we have one of the lowest cost in the world in terms of doing the transaction, in terms of authenticating the customer, which is a digital infrastructure as a country we have got now, which helps us grow faster. And we have got the maximum number of digital payments in the country. That's what I understand from many of the experts like you. So anybody else who wants to add anything on digital infrastructure, and digital lending? Otherwise, we will move to the next topic, which is profit
Dinesh,
before tax.
I just want to add one point here. I think there is
Sure.
digital infrastructure and there is credit infrastructure, and I think both are very, very
Yeah.
important. And I
Yeah.
completely agree that there is a lot of scope to go down the pyramid, but lending is a very, very responsible business. And when it comes to that, particularly as you go down the pyramid, it becomes even more important that this gets done in a certain manner. So the point I'm trying to make is that technology can help solve a very big part of the problem, but I think that there is a basic science to delivering credit, and one shouldn't underestimate the importance of that.
Okay. Great point. So, okay, so Shama, I'll come to the next point, which is basically very, very important, and especially in a country which has got 130 crore people. How do we serve the underserved? And you are basically running a company which looks at, making credit available to a lot of people, which would not have been served by the larger banks or organizations. So how do we make this whole sector, enable to serve the lower strata of the society? How do we, what would be the enabling changes you would like to see?
I think there are a bunch of things, right? I mean, I think the most important thing is that we need to recognize that NBFCs are playing a very, very big role, and these numbers are not new, but uh, the formal access to finance in India is still is 8%. We're still talking single digit, and if you look at the numbers of the Indian population that has borrowed in the last year, 42% of the Indian population has borrowed. So 42 minus 8, that is 34% of the Indian population is borrowed from informal sources of finance. And I think it's important to recognize that the problem is very, very big. There is ample room here for many, many banks. There is ample room here for many, many NBFCs. Credit is not as simple as it sounds, right? So basically, you could talk about secured, unsecured, tenor of the credit, the way one underwrites the loan, the risk of the loan, the repayment cycles, and so on and so forth. So I think there is a lot more complexity, there is a lot more variety, there is a lot more product that needs to be brought. And I think that's sort of the direction I am seeing the NBFC sector taking in some ways. While great work has happened in the fintech space, my sense is that it's just a sliver. It's really, really scratching the surface. I'm seeing the need, the opportunity to go far deeper into the Indian sector, reach out to many more, and I think that's really sort of the big opportunity. I think one point that I would like to sort of highlight, and some of the speakers initially did sort of focus on it. See, if we recognize that NBFCs play an important role, then the question is, how do we sustain them? How do we make sure that in good times and in bad times, NBFCs continue to play that role? And absolutely no question that if we are dealing with the underserved, if we are in any shape or form availing public money or accessing capital, then we have to follow the highest standards of governance and reporting, whether small, mid-size, large, no questions about that. But the question really is that when a sector, when the economy goes through crisis, and we've seen many of those, I think the NBFCs get hit very, very badly. And the problem is that these are real people, these are real businesses, this is real capital, these are real investors, and more importantly, these are real customers at the bottom of the pyramid. And from one day to another, you find this, the tap just switching off. How can you sustainably build access to finance if the tap just switches off from one day to another? It reminds me of Mark Twain's, quote on the banking system, give you an umbrella when it is nice and sunny and take it away when it's raining. So the point I'm trying to really make here is to say that we need institutions, we need support, we need an ability to ensure that we don't dig the well when we feel thirsty, which means that we need, whether by way of an institutional infrastructure, whether by way of a product, we need more capacity for lending in the NBFC space, and perhaps an intervention at a very, very different level as far as ensuring that that capacity gets sustained through periods of ups and downs. Because what you don't want is when the going is good, lots of NBFCs all going well. When the going is bad and when a customer really, really needs that loan is when NBFCs face the most challenge in terms of accessing capital. How does one deal with this situation? I think that's the biggest puzzle that we need to solve.
Yeah, I think one of my banker friends told me that, banks lend to people who don't need money. So
No, so I think if I can add to Kshama, I think what the perception is or what people want is NBFCs should never fail,
yeah,
right? Because whenever a NBFC fails, all the NBFCs are painted with the same brush.
absolutely.
And I don't think I have ever seen any industry. I mean, you take any industry, the steel
Right.
industry, the auto industry, whenever you have 100 players or 200 players, and in our case, we have, I don't know how many, 500, 600, 800 NBFCs. There will be some NBFCs who are good NBFCs, and there are some NBFCs who are not so good NBFCs. So if you go by the free market principle, some have to fail. So why is it that only when an NBFC fails that such a big hue and cry is made? And I'm sure Umesh will support what I say. If you go into history of the amount of money is lost and you compare that between banks and NBFCs on an overall basis and on a percentage basis, I am sure NBFCs has performed far, far better than banks.
I think Gaurav, that would be an interesting study. Maybe we should commission it as PwC and share it with you that, how over uh, at least a 50-year period, NBFCs and banks have worked out. That would be an interesting work if we can work on it and come back to you. That's a good idea.
Dinesh, I'm really tempted to jump in here after Gaurav's
Yeah.
comment, if you'll permit me.
Yeah.
Yeah, so I don't have 50-year data. I have more like 10-year data, and I just do want to share how it looks like. So this is not so much about Northern Arc. This is really about the NBFC sector and the many small, mid-sized, large NBFCs that Northern Arc has been working with over the last decade plus. And in some sense, if you look at Northern Arc, it's really an index. It's an index of NBFCs of sorts. And just to share with you some numbers, on a 10-year horizon, our NPS plus write-offs are in decimals. I'm talking less than 1%. Yeah.
Okay.
And this is not about Northern Arc. This is about the underlying sectors, the underlying NBFCs, the underlying pools and portfolios, the geography of India, which is pretty much covering all parts where there is some financial institution or the other. But that's a very, very interesting number to speak about. And, Gaurav sort of, made me draw attention that we may not have like 50-year data, but we do have a 10-year data point here where a pool of NBFCs, a very strong group or a very strong a section of NBFCs, once you put them together, this is the kind of performance one sees in terms of risk. So to say that NBFCs are risky, to say that, NBFC borrowers are risky, I think that's just painting everyone with the same brush. And absolutely agree with Gaurav that, we just need to make sure that the incentives are all aligned. We have a very clear form of reporting and governance, and people who act funny pay a price for it. But there will always be NBFCs that will fail.
That was very interesting point you shared because that is very counterintuitive to whatever we keep hearing and thinking that delinquencies would be in places of decimal. That's very interesting. I'm sure a lot of our audience, it would be a welcome data point for them to research, and do more analysis around it. But if we can do that, then obviously cost of funding and financial inclusion can go places at a much faster pace than where we are doing right now. So that was great.
With your permission, I just want to add to what Kshama said. Would that be okay to come in for a short minute?
Absolutely, we have all the time. Don't worry.
Right, fantastic. Let's look at two asset classes. Let's look at housing. I think it is well established, secured asset class, end use clearly identifiable unless you're into construction or wholesale financing. Retail, basically, let's look at retail lending, housing and affordable housing. Well-run companies now for literally we can see decades or we can see a short to medium period of, let's say, medium period of 5 years. And Northern Arc or beyond, we can see anywhere. Underlying asset is performed exceptionally well at less than 100 bps GNPA. Similarly, why I know the education asset class is very well spoken about, and NPS people talk about at a very differential level. But if you pick any bureau data or you pick the education ministry data, loans greater than 10 lakhs, higher education loans greater than 10 lakhs, every single non-banking finance company, including private banks, scheduled commercial banks, cooperative banks, everybody put together as a cohort universe, and this is 90% of the overall assets within education, has less than 100 bps of NPA now for over 10 years. It is the sub 5 lakh rupee loans that did not behave well. And I think one of my fellow panelists was also talking about it in terms of cost of delivery being high and credit risk being high for that sub pyramid, which is colored the entire segment. So I think it's our job to take it to the rating agencies, investors, and everybody else on what is the narrative and then show it with data.
Yeah.
That's another role that we need to play. In fact, if I may add, there will be companies today rated in the A family or a notch above or below, but their cost of borrowing could be completely different. It is established that companies who are borrowing on asset-backed approach and not on cash flow have not done well. We can see this
No, but
cost of borrowing. So market investors, creditors, namely, are very naturally they are talented, gifted, sharp people. They know who to lend to and at what cost. They are factoring it in. I
Yeah.
think overall NBFC. Let me wrap up by saying NBFCs are in a far better zone than where we were. I did not come across a single. Uh, Sorry if I'm wrong, but I don't think I came across a single respectable mid-size, small-size, large-size NBFC which failed post-COVID, right? And why? Look at the financial health. People are looking at capital adequacy, liquidity, NPAs, overall profitability. Regulator is taking a lot of progressive steps. I think the RBI framework on scale-based regulation is a big impetus. Short-term, people will say it's a pain in implementation, but that's okay. That's their personal view. Medium to long-term growth comes with structural intervention only for the sector. Look at the recent circular around 2025 CFSS, Core Financial Service Solutions. I think it'll bring all the big boys, as in the big NBFCs, in play. There will be a cost of compliance, right? I was talking to a very senior board member, somebody who's been on various boards for the last 20 years, and the first question the gentleman keeps asking is what is cost of compliance vis-a-vis cost of sustenance?
Yeah.
And if we are focused on investing today on cost of compliance and running our business well across the four financial health parameters that I namely spoke about, which is let's say capital adequacy, liquidity, NPA, and overall profitability, with fintech adoption, big data, if we can reduce our cost of delivery and onboard better credit, then I think we are in a great zone.
but Dinesh, I think all
Yeah.
of us will support PwC doing a study in the last 10 to 15 years, banks versus NBFCs, who has performed well.
Okay. Perfect. Let me come back to you with a very specific thing on what we can do around it, and how the data looks like. That's very, very interesting. Okay. I think last topic, it is more related to what I do, which is basically mergers, acquisitions, and consolidation. And it would be great to get views from all of you as to how do you see the transactions happening in this space in terms of consolidation or loan book sales. So Gaurav, maybe you belong to the group which does maximum number of transactions in the country. So maybe we'll start with you on this one.
So why do mergers and acquisitions happen? Right? They happen for a couple of reasons. One, scale. You get purchasing efficiencies. You get ability to get to a different geography. Then you have backward integration. You have forward integration. Those are also drivers for mergers and acquisitions. But unfortunately, in the NBFC segment, I don't think any of these kind of are relevant, because we find the smaller NBFCs, or so there's nothing like a scale benefit, or
Gotcha.
there is nothing like a forward or backward integration. An NBFC focused on a niche segment, as like Amit said, or someone focused on a niche geography, they do as well on their return metrics as a larger, full service pan India NBFCs. So, in spite of there being so many NBFCs, I think it is one segment where we have not seen as many mergers and acquisitions as perhaps we have seen in any other segment. And I do believe that will continue to be the case.
I'm very disappointed, but but that's the reality.
I feel for you, Dinesh, having been on that side of the table.
Yeah, I know. So maybe we'll get some better views from somebody else on the panel.
No, so if I can just add, I think mergers
Yeah,
and
Rakesh.
acquisitions, uh, it's at what cost are you acquiring and what are you really achieving through the merger and acquisitions. And as Gaurav mentioned, if it fits the strategic intent for a company in terms of uh, adding a new geography, adding a new business, I think then it makes sense. Otherwise, yes, what consolidation which has happened is there are two, three large NBFC or housing players have moved out or has vacated the space. There, some consolidation is happening in terms of the shift of business which has happened. So those things has happened. The problem is, in a business like ours, when you want to acquire something, you have to pay a multiple two, 3x and all. And then you have to look at whether your ROA, ROE in the next 5 years, whether it makes sense or not. And that becomes a very difficult proposition, Dinesh. And then when you have an opportunity like what we have, that you can grow your organic business by 20, 25% or 30%, you think why not build your business organically rather than looking at merchants and acquisition? So clearly, for a group like ours, we evaluate all transaction which comes in the market and all. But at the same time, what do you pay for it? How does it really, in terms of work for you strategically, and also from a return point of view? So I think one needs to really look at everything very
Yeah,
holistically to just acquire something.
yeah. No, many of the transactions which have happened in the space are all stressed, or I would say majority of them were larger was stress based.
Yeah.
From growth perspective, there are very few, far and few in between things which have happened. I clearly understand that, but everybody else who sees that, how the market is.
Dinesh, 2 points from me here. One, completely agree with Rakesh. In fact, Rakesh is being humble in saying multiples of 2, 3, 4. These days, sellers want 4, 5, 6 and more, right?
Yeah,
And now, if you're buying at that price, whatever you deem appropriate is a fair price, you will logically have a plan to say, hey, what next, and how does it add to my strategic imperatives in creating stakeholder value, right?
yeah, absolutely.
The second is when people do these M&As, one thing they undermine is the human capital, right? What is the NBFC business? What is the raw material for us? Money and people, right?
Yeah,
None of us manufacture anything, right?
yeah,
In the non-banking finance corporation business that we do as a cohort, as a sector segment, whatever we choose to call it, what is our raw material, right?
yeah,
Lending, capital for lending or equity stroke capital, debt, and most important is people. So we cannot undermine human capital. And
yeah,
how do people treat them after they acquire? And how do they merge?
yeah.
These are, I don't think I have the answers on them, but we have to be mindful of this as we walk this journey.
Absolutely, absolutely. No, I completely agree with you. So I think if we don't have anything, I think we are coming at the top of the hour of this very interesting and fascinating discussion we had, and we covered various topics. And to summarize, talked about how the role of NBFCs can be important for the economy. And what we clearly understood was that this is the sector which government needs to support, because not everywhere banks will be able to reach. And NBFCs are adopting technology in a big way, which will further reduce the cost of transactions and help in proliferation and in reaching the masses, and also help in reducing the NPS, as I understood. So clearly, a big road forward for NBFCs, and good growth rates, credit possible. And as Shaman brought out that, 3/4 of the lending is in terms of the numbers is happening through non-banking sector, and that is more likely to grow. So all of us need to see that there is a clear path available, there is compounding available, and how do we make it possible so that the sector is able to participate in a much bigger fashion than what it has been doing in terms of the growth path of India. And personally, for me, it was one of the more interesting moderator jobs I have done. And so I personally need to thank all of you for this, great comments and the preparation that you had done to share it with our audiences. And thank you to the ET team for organizing it. If somebody wants to give any closing comments, that would be very helpful.
I'm happy to come in. I'll simply say I think what happened in e-commerce a few years ago in terms of co-opting is how I believe it will unfold. Regulators already given us the guidance. Let's say illustrative co-lending norms that are now applicable. I think if banks and non-banks start co-opting uh, and do responsible credit, last mile delivery, leveraging their complementary skills, and there is clearly complementary skills. There are advantage they have on CASA, the advantage, let's say NBFCs, we have on last mile delivery. Uh, we can create a real unique proposition and do our 2 cents on what is the big dream, right? $5 trillion economy by 2025. I don't know 2025 or no, but directionally, I know India is in a good space. I think that we'll all agree with, right?
Sure.
Dinesh, if I can just add one last point.
Yeah. Please.
Completely agree with Amit. And I do think that this banks versus NBFCs is in some sense a little too soon in India to talk about a discussion like this, given that just 8% of our population has formal access to finance. And to just set the benchmarks, if you look at developed countries, 65% of their population has access to formal sources of finance. So I think there's a long way we have to go before we start worrying about are we a bank, are we going to be an NBFC. I think what's really important is consumer gets access to finance.
Absolutely. Okay. Thank you. Anything else? Umeshji, Gaurav, Rakesh?
Yeah, one last thing I would like to add. Yes, the fintech technology, all are good. But one thing, the kind of customers we are addressing, most of them require digital assistance to start with before they do it themselves, because ultimately digitization means doing it yourself. So as long as the digital assistance is required for the customer to come on to digital platform, it is going to take time. And till that time, probably we need to take journey as a together and educate the customer to come on the board. So we have the responsibility to make that transformation a foolproof rather than rushing towards total digitization and taking getting off the track. So this is something which all of us have the responsibility to make it happen. So I think with that I will close my words.
Okay. Then we call it a day. Thank you. Those were very kind words, great words. Thank you.
Thank you. Thanks, everyone.
Thank you.
Thank you.
Thank you.